This is how it reacts during a market crash as an example. So you could see that when the market comes down, these lines pop up even higher than where, if I go back, you could see here, this is where, if you look at the vertex here of the trade, you can see that the T0 line kind of intersects at that same level. Whereas when the market crashes and IV spikes, you can see that the line over here popped up. All right. And then if the market now does come down and IV spikes, these lines all kind of pop up and you get some juicy profits there with a market crash event. All right. But you do need to learn how to size these things properly to your income trade. And that is what you learn in the course and the mastermind. And here's the mechanical backtest of that. You can see, again, with this crash, this is now the putback ratio based on TA, and we get similar pops there in terms of profits. There is a small element of drag, but you can see it's very small, right? Quite gradual. And for certain types of market crash events, we get nice pops there from a hedge, which is what we want to see. And this one was with 4 red flags, and then this is with 5 red flags, similar to what we saw before. All right, so those are the key forms of extra hedging that we have in place. So one of the things you might be asking then is, how do I take profits on that? And that can be surprisingly tricky because during a crash event, it's really nice to see these extra hedges really blow up in profit. I shouldn't use the word blow up, but increase in profits, and your greed will kick in when that tends to occur. And you'll then say, oh, tomorrow I might make even more, right? So, but what happens is that when you're in a market crash event, yes, volatility can keep spiking for sure, but at some point, the market's going to bounce, and it's not unusual to see the bottom bounces and IV just get completely crushed when that happens. And you could be in a scenario where you're like up here and, you're laughing because you're saying, sweet, I'm, getting huge profits from this particular hedge. You keep holding. And then when you get that huge spike in the market bounces and IV crushes, this thing over here now drops all the way down to here. All right, well, the market's coming up. You might be down here as an example. Okay. And you've now lost those potential profits that you could have cashed out on had you booked those profits when you're here. So basically, the nutshell is that you need to have a trade plan which tells you exactly how to get out of these hedges when they're making money. So the way that we track that is that we track a multiplier of the initial price that we bought this hedge at originally. So in other words, if I buy it at 1x, then there's a certain multiplier over here that we then say, okay, from this point forward, we are now going to start tracking a trailing stop of this position now that it's hit this activation level. And then if it comes down a certain percentage, and again, we're specific about this in the trade plan, right? But if it comes down a specific percentage from the peak profit, that is where we cash out of that extra hedge. Okay, but the key is you just need some form of a mechanical form of getting out for profit from these things, because from experience, I can tell you that greed kicks in when you see this, right? Sometimes it works, sometimes it doesn't. I had one guy during a crash event say my entire account just went up by 30% because of all these extra hedges that he had. I'm like, make sure you've got your plan and follow the plan, right, to get out, because those profits can evaporate very quickly when you see that market bounce and a big IV crash.